You went to school to memorize facts you never use. You were trained to raise your hand, wait your turn, and follow instructions. Then they told you, get a job, work 40 hours a week, give half of it to tax, retire at 67 if you're lucky. That's not a life. That's a script. And most people don't question it because they're too tired from living it. But once you see it, you can't unsee it.
The end of cash could be near, and a new currency system could come sooner than many of us are considering. So today, we're going to investigate why so many bank branches are closing down across the world and ask the question, is this the beginning of the end for cash? And then we're also going to dig into a report where economists are sounding the alarm on what they say is the #1 biggest risk for the Trump presidency, which are bank runs. Now, personally, I find that extremely suspicious because some of those same people are also saying that the economy is strong. Well, if the definition of a strong economy is drowning in $37 trillion in overwhelming debt that's going to be passed on to my unborn grandchildren to pay, then yeah, our economy is super strong. Now, we're also going to cover the Fed's recent banking stress test that was ran on 22 different banks, all of which, probably no surprise to you, passed with flying colors. However, many people are saying that the stress test was the easiest stress test ever performed on banks, not because the banks are super strong and resilient, but because they are incapable of handling a true, real-life economic collapse stress test. Now, think about it, guys. They stress tested about $550 billion in defaults. We have about $600 trillion in derivatives alone. $550 billion isn't even 1% of that $600 trillion. All of that to say happy Tuesday and welcome back to Real Estate Mindset. You guys already know that this video is going to be absolutely bonkers. Mitch Vexler, sir, how are you this morning?
Good morning. Gold is up just a hair. It's up about $35. NASDAQ is down 0.22%. It's basically been a very flat evening and early morning in the markets. We'll see what the day brings. But this should be a very interesting video because you're seeing it yourself in your own neighborhood as to what's happening. We're going to explain it in a few minutes with regard to the banks and the closures of the branches.
This article is brought to us by Zero Hedge on June 28th, which was this Saturday, titled "The End of Bank Branches: How Europe's Digital Euro and Stablecoins Are Reshaping Finance." Now, I thought it was really important to go over this, even though predominantly this article is talking about Germany, because we are experiencing all of the same things as Germany. The digital age is dawning, repetitive tasks are being automated, and technologies like artificial intelligence and autonomous vehicles are reshaping our daily lives. Just as the financial sector is undergoing a profound digital transformation, the slow disappearance of physical bank branches is one of the clearest signs of this upheaval. The desertion of Germany's town centers is a symptom of this new era. High rents, shrinking consumer power, and demographic decline, especially in rural areas, collide with the shockwaves of e-commerce and a rapidly digitized economy. More and more of our consumer habits are migrating online, and the banking industry, long anchored by its brick and mortar branches, is no exception. Now, this is a long-term trend. And again, as I was reading that, I'm sure you guys were thinking that, yeah, we are going through the exact same thing here in America. The quiet death of Germany's bank branch networks has been underway for years, a global phenomenon driven by customers embracing online banking, decentralized access to investment portfolios, and other digital financial services. The latest data presented confirms this trend. In 2023 alone, German banks closed approximately 560 branches. That's a 2.8% reduction in just 1 year. That may sound like a moderate consolidation, but in context is part of a decades-long structural shift. 10 years ago, German banks operated more than 35,000 branches. A quarter century ago, that number was closer to 60,000, but today they only have 18,933. In March, industry giant Deutsche Bank announced major job cuts during its annual press conference, citing the need to boost cost efficiency in light of ongoing sector changes. We are witnessing a fundamental transformation in the German banking sector. And again, you guys, that's spreading well past Germany into really the entire world. Customer consultations, he explained, will increasingly take place via video and phone. So the death of customer service, I mean, isn't that what this says? This marks not only a cost-saving shift, but also a paradigm change that threatens to erode the personal trust traditionally built in face-to-face banking relationships. The business becomes leaner and more efficient, but less personal and perhaps less trustworthy. Since 2018, an average of 1,646 bank branches have closed each year. And between 2012 and 2022, the number of commercial bank branches in the U.S. decreased from 82,461 to 69,590, or a 16% reduction in just 10 years.
We do have some breaking news. Those Fed stress tests are out, and Leslie Picker has it for us.
Hey, Morgan. Yes, all 22 banks tested remain above their capital requirements after absorbing hypothetical losses of more than $550 billion this year. The scenario by which the banks were tested against was widely seen as more moderate, evidenced by the aggregate decline in the Common Equity Tier 1 capital ratio of 1.8%, the lowest decline in years. The 2024 results, by comparison, showed hypothetical aggregate declines of 2.8%. This is the first round of stress tests with Michelle Bowman in the vice chair for supervision seat, although the test was developed before she took that role. Under this new regime, though, there's been a broad expectation of loosening capital requirements and regulatory reform. Just this week, the Fed proposed an easing of another leverage rule. Bank stocks are up about 4% over the last week on optimism surrounding capital. As for today's results, though, Vice Chair Bowman said in the statement that, quote, one way to address the excessive volatility in stress test results and corresponding capital requirements is for the board to finalize the proposal that would average 2 consecutive years of stress test results, which was released in April. Fed officials said that the better results this year were driven in part by the way the test was designed, as well as the strong recent performance from the banks. The hypothetical losses included $158 billion in credit card losses and $124 billion in commercial and industrial loans. On Tuesday, the banks are expected to each provide details on how the results of this test impact their plans for buybacks and dividends.
I wanted to remind you guys about the derivatives market. There is a large difference in the notional value and the actual netted value of derivatives. So remember, there's probably more than this. Okay, but this is saying, okay, Investopedia, as of 2021, so there's more now, $600 trillion in derivatives, of which is valued at $12.4 trillion. So 12.4 trillion is levered up about 40 to 1, and now we have a $600 trillion time bomb. Mitch, I don't know if you caught it, but they're saying that the banks did better than they have in years, but they also said that they designed the test differently. So it's not even the same test that they're comparing the previous years to. And she also made it seem like they designed the test, the stress test, so that it would be easier for them to pass. And if they're only stress testing some credit card debt, 550 billion, and the derivatives market is 600 trillion, that's less than 1%. Mitch, are these stress tests real? I mean, literally, are they real, or is it just some propaganda BS because it's nowhere near capable of handling the incoming economic turmoil?
Her comments are literally 100% propaganda without the benefit of intellect. There's a document that we're about to let loose on the upcoming live video that I've been working on pretty well round the clock. And in quantitative finance, there's multiple layers of derivatives. So there's a first tier derivative, second tier, third tier, alpha, beta, delta, gamma, theta, rho, verta, voma, vana, speed, charm. These are all derivatives of the Black-Scholes-Merton formula. Well, we have the same level of derivatives, 8 levels of bank financing derivatives. And we're going to explain that because I wrote that all out in this upcoming document. But when you look at how many banks owe money to different banks and owe money to different governments, and governments owe money to other governments, these are all derivatives of financing under the hood. None of that was mentioned in any of these. Well, we're going to reduce the regulations on these banks. We have a debt crisis. It's extremely serious. It will blow to shreds unless the debt is dealt with. So no, she is stupid, moronic, a midget mind, and somebody that has no business being in government because the laws exist to prohibit these things. Nobody wants to pay attention to the laws, so the governments have blown the debt so far out of proportion that something bad is going to happen. There will be a trigger, i.e. a long-term capital management type situation where the debt leverage was 250 to 1. And under the hood of all this, that's 600 trillion. That's just on our side of the planet. That's not in total of what's going on around the globe. And that's what I broke down in this upcoming document. All the layers of debt that erode from one government to the other. And then as far as what we just saw in the Zero Hedge article, can you imagine a situation in the United States where you end up just like Canada with 4 banks? Why would you deal with any of these banks? And that's the problem. So they're using AI to eliminate human beings, to reduce their overhead. But the ramifications of that, which is where these midget minds cannot see 2 inches in front of them, crime goes up as unemployment goes up. They're directly correlated. These things are all hooked at the hip, and we don't have serious people looking at fixing this problem. You cannot kick this can down the road. We're here now. It's real. You can see the ramifications. How many tens of thousands of people that work for these banks are going to get laid off? And you're just being steered as a customer. You're being steered into their funnel to stroke their valuation when they're the ones that are creating the debt. The system is twisted, is broken.
Mitch, I think about this a lot. We kind of talk about it a little bit. This is an impossible debt to pay off. I mean, it's an 37 trillion in debt is impossible to pay off if they're talking about paying it off, but they're not even talking about paying it off. So it's extra impossible because they're not talking about it. So I have no other conclusion here that this is the beginning of the end of the dollar. Do you see the same thing happening? I mean, is this the end of the dollar? Is there going to be a new financial currency ushered in here? Because literally, I mean, we talk about this all the time. It's impossible to pay the debt off. My unborn grandchildren are going to be responsible. Is this the end?
Well, I think if your question is it the end of the US dollar? No, because we already discussed that. The globe needs these dollars. Now, yes, you could say that the BRICS want to put their own SWIFT type program in place, which is the ability to do business with one country to another and transfer the cost of the currency simultaneously. That may happen, but nonetheless, the rest of the world needs US dollars. We are the reserve currency for the globe, like it or not. So I don't see the US dollar going away. One would hope that that's not the case. The problem isn't the US dollar. The problem isn't the idea that Russia or China want to create their own SWIFT program. The problem for all these governments is the debt that they have created. So until they deal with the debt, the idea that we're going to go create another currency because we couldn't deal with the debt in the first place is nonsense. Would you want it? I mean, it makes no sense. You're going to have to deal with this debt. And people are going to have to realize you made investments in items that were fraudulent. Now, when you understand the derivatives, most of these derivatives are not backed by mom and pop, right? These are interbank, agency bank, as in banks to private equity, loans, credit default swaps, CDOs, CDLs, mortgage-backed securities. These have nothing to do with mom and pop. They believe initially, well, they were guaranteed by this asset. Well, you can't get to the asset, so no, it's just paper chasing paper. The government is going to have to get involved and say, that's it. You banks have got to unwind this nonsense. And when you start peeling it down, okay, you know, if we can get the US debt down to 20 trillion, we've got something from which we can start over 15 years by virtue of law saying we can pay this off. But it's gotten so far out of hand. And the other thing I want to explain to everybody, you must realize the size of $1 trillion. Yeah. $1 trillion is 1,000 billion. So when you look at this and you start saying, well, wait a minute, in total, there's 600 trillion of this nonsense floating around. It's mathematically impossible because mom and pop don't have the money The companies themselves don't have the money. That's why it's leveraged. And in certain instances, like long-term capital management, levered 250 to 1. The money was never there under the hood to begin with. It literally is like going to Las Vegas and playing craps. Do I get paid? Do I not get paid? That's not a business. That's not a model. That's a wish. And it's a debt wish straight into hell. The governments are going to have to get involved across the globe. And that's the great negotiation that must take place. How are we going to get rid of these derivatives under the hood for all the governments?
Yeah.
That's how you bring everybody together, because if you don't know where, just like long-term capital management, you don't know what the trigger is, but the trigger is there. The debt is there. The leverage is there. So which country triggers it? And that was the reason why I put that report together. If you think about it, you've got dozens of countries, dozens, that owe China money. What happens if just 10% of those countries, like Angola, what happens if 10% of those countries default? Is China the actual trigger that brings down the economics of the globe? Could be, but it gets worse. We're in the exact same boat. Our government loaned to other countries.
Yes.
If 10% of those countries don't pay, what does that do to our US debt? And is that enough to send the ultimate shockwave, the trigger, across the globe?
Right.
Could be.
You know, honestly, and probably some of those, and I can't wait to talk about your workup, but some of those countries, for example, that owe money to China, also, like you just said, owe money to the US. So I'm wondering if they're borrowing money from the US to pay China or vice versa. I mean, it is literally, it's a giant worldwide global Ponzi scheme. They successfully created a Ponzi scheme in the banking sector. It's the banks are propaganda at this point. 401ks, pensions, all propaganda at this point. If you really want to invest, you just got to learn investing. You got to look at the math. When I found out that gold outperformed all markets except crypto over the last 10 years, I'm like, I'm done with everyone. I'm done. I gave them their chance, right? Over 40 years of my life, I'm done. You lied to me. I'm not going to get over it. Which brings me to the next thing, unwinding. You said unwinding. And I think one of the reasons why they're not unwinding right now, Mitch, is because they can't. Because if they start unwinding, it's going to lead to bankruptcy and bank runs. Why preventing bank runs must be a top priority amid financial turmoil. So a few good things here, you guys. Investors around the world have long regarded the U.S. financial system as the most stable, liquid, and reliable in the world. So remember, if the U.S. goes down, the rest of the world follows. And therefore, I could kind of make the argument that the rest of the world is propping up, just like mom and pop, American mom and pop, is propping up all of this fraud and corruption and greed. But U.S. President Donald Trump, recent tariff announcements, repeated questioning of the sovereignty of Canada and Greenland, and bullying of the Federal Reserve Chairman Jerome Powell. When I read that and it said bullying, I'm like, actually, like they're using that as a derogatory manner, like, oh, he's picking on the Federal Reserve and poor Jerome Powell. But now that I know who Jerome Powell and the Federal Reserve is like, you're not bullying them enough. You need to bully them even more by shutting down the Federal Reserve. But regardless, this goes on, must just be on the verge of changing that. The global spike in volatility and the sell-off in equities have been accompanied by a rare phenomenon, a sell America trade mindset, with investors dumping not only U.S. equities, but also traditional safe haven assets, such as United States Treasury securities, leading to wild swings in the Treasury yields and depreciation of the U.S. dollar. If panic hits the banks, an economic downturn often follows. So remember, and I've said this all the time, in 2023, when they bailed out the banks in 2023 with the Bank Term Funding Program, they kicked the can down the road. We were experiencing deflation. And so they did that and they reinflated every single asset by saving the banks, and they allowed those banks to continue to leverage up our assets. As long as a panic is limited to asset price fluctuations, the consequences may be manageable. However, and there's a big however, much more dangerous risks lurk if panic hits the bank, either because the disruption in treasury markets affect their access to wholesale funding markets, or because it triggers an old-fashioned bank run of the kind last seen during the 2023, here it is, Silicon Valley Bank episode. A perhaps unprecedented fact about such bank runs is how damaging they can be, even when, as is true today, banks are relatively well capitalized and have been making profits in recent years. But again, it's a highly leveraged up, toxic asset holder is what banks are right now. A research paper studying many hundreds of bank run episodes over more than 200 years around the world suggests that these events tend to be followed by major recessions, even when banks were fundamentally sound. So followed by major recessions. Let's keep going. The unusual origins of the current panic. While temporary downturns in equity markets are nothing new, as any seasoned market participant can attest, the origin of the current one is clearly unusual. In the past, outright bear markets have often followed periods of what turned out to be excessive optimism, like we have right now, such as the dot-com bubble or major financial crisis. But the difference between those two crises and right now is 100% the inflation. 100% the inflation is the biggest difference. Rarely have the comments of a U.S. president moved markets more, especially in an environment of low unemployment, robust growth, and normalizing inflation. Normalizing inflation. So they want to normalize theft, normalized government theft. This unusual situation also makes it difficult to contemplate what might happen to the banking sector. In the past, the combination of a buoyant credit growth coupled with loosening credit standards in a low interest rate environment has often put a precursor to pressure on banks' balance sheets, if not outright financial crisis. However, despite the rapid growth of potential risk factors such as the expansion in lending to providers of private credit and the increasing potential for climate-related events to affect credit losses, most observers do not foresee major risk to financial stability until recently. And that's because the public is forcing them to talk about the debt.
The big banks all passing the Federal Reserve's annual stress test, but that's not the only reason the stocks have been heading higher over the past month. Well, our Leslie Pickett joins us now with more. Hi, Leslie, good to see you. What's been driving them higher?
Hey, well, good to see you too. So they've certainly been moving upward. The S&P Banks Industry Group surging to a fresh record today once again. Investors driving up these names on just a slew of indications that the regulatory chokehold that many executives have been complaining about for years is attenuating. Friday's easier than usual stress test means the banking system is poised to return more capital to shareholders through dividend hikes and buybacks. Those will be announced tomorrow after the close. As analyst Mike Mayo put it in a note this morning, quote, "The Fed stress test is a clear demarcation that regulation is becoming less onerous, less volatile, and more transparent." Mayo says the test freed up an estimated $100 billion in capital, which is enough for more loans, $1 trillion worth, theoretically, deals and buybacks. Now, even though this test was the first overseen by new Fed Vice Chair for Supervision, Michelle Bowman, it was actually designed before she took that seat. Still, the hypothetical scenario that they tested was seen as the easiest in years. And that's because the banks took the test at a better starting point from a fundamental standpoint, but there were also very low trading losses reflected in the test, which may simply reflect auspicious client positioning on the day of the shock that they were tested for, according to JP Morgan's research. Wells Fargo, Goldman seeming to benefit the most from this, according to JP Morgan, with Goldman experiencing almost zero trading losses in the test. Still, the street is taking that element as a potential anomaly this year. But on top of the easier stress tests, the Fed is moving forward on a proposal that will loosen another capital requirement, the supplementary leverage ratio, and that is furthering investor optimism around just this overarching theme of capital freedom, essentially, guys.
I love that you brought it up because I wanted to ask about the SLR and Leslie, exactly what the process is from here. So is it a kind of given that this is going to change? Do we know how much it's going to change by? I mean, analysts, when you see Mike Mayo talking there about extra money to return to shareholders, are they factoring this SLR change in yet, or is it a sort of extra benefit to come if it all gets confirmed by the end of the year or whenever it might be?
Sure. So they go through a comment process from here, but it does appear that while it's not a ubiquitous agreement that this needs to be changed, there were essentially two dissenters that didn't like this idea. They thought that it left the system more vulnerable to systemic risk. But basically, after that comment period goes through, then I do believe that most analysts in the street expect it to take effect, and it would essentially cut in half the amount of extra capital that these banks need to hold against their entire balance sheet. This is seen as essentially a backstop against the more risk-weighted capital that we see from the stress tests and other elements as well. They basically had to hold additional capital against their entire balance sheet, regardless of risk. So they're holding capital against things like treasuries and other areas that are perceived to be risk-free. So that was something that has been perceived as a need for reform for a while now, given that we've seen some stress in the treasury markets, and banks say that that makes them less inclined to intervene, since holding treasury is essentially a knock on the amount of capital that they need to hold. So that's something to watch.
Well, I disagree. If there was a regulatory chokehold, then how did they accumulate $600 trillion in derivatives if there's a chokehold? What it sounds like is they're at maximum capacity and they want more fees, more commission. They're saying half the reserve requirement. What happened to Basel III? What happened to Basel III? Half the reserve requirements, less regulation. Now, normally I would say, great, less regulation, but I think what they're saying is less regulation plus a bailout. How likely do you think it is that the stress test is going to fail and we're going to be right back in the same situation as we were in 2009 and even in 2023, where they're bailing out the banks once again? What's that probability that they start bailing out banks within the next year or two?
100%. And the stress tests have already failed. So you missed kind of a point that she was hitting on, which was, well, the share prices of these banks will go up with less regulation. Who cares? It's not the share prices of the banks. These people are so dumb, they literally missed the entirety of the issue. The cost of the interest carry on all these derivatives is many times greater than the total cumulative value of all the shares of all the banks in the United States. They have completely missed the entirety of the point. The debt is so great that the value of the banks is negative. That's the truth. So now what they're saying, which you are right, yes, the banks are at max capacity in terms of, well, we've blown this system up, both on balance sheet and off balance sheet. So now we want less regulation so we can pump more money into the system to try and blow it up even further. These banks are going to need bailouts, but my point of the matter is, why would you bail them out? The reality is that, as I said, the greatest negotiation ever to be done is going to be the coterminous global reduction of derivative debt, both on balance sheet and off balance sheet. That's the job of the government, because if they don't, the system will blow to shreds. You will end up in a greater depression. You will end up with banks that are dead man walking, that literally have zero value. You will end up with the bank runs. You will not be able to stop it. You must reinforce credibility. And the way you reinforce the credibility is you walk back these derivatives, both on balance sheet and off balance sheet. It's the off balance sheet that where the big problems are. So by doing that country to country and saying, okay, we hold this, we hold that, they hold this, they hold that, these are accounting adjustments where, yes, some people who paid money into those particular derivatives aren't going to get it back. Too bad. You gambled, you lost, but you cannot put that economic risk, cost of carry, cost of interest on the back of mom and pop that don't have the money to carry even the central appraisal district fraudulent outstanding valuations, which are created by the school district fraud. It's the same problem. The Federal Reserve and the school districts are a mirror image of each other. They've lied to the public. They've blown the bubble so big that the public doesn't have the money to pay off. And therefore, you must have these principal reductions. You must have these derivative reductions. And if you don't, it will blow. And when it blows, crime will skyrocket. If you think New York's got a problem now, wait for that to go down with the banks in New York. Good luck.
All right, guys, we're going to wrap this video up. Don't forget to comment below. Let us know what you learned. Let us know whether or not you agree with us. Is there going to be a new currency, not new currency? Will there be bank runs? Are the banks just fine? Is the economy just fine? Either way, comment below, share your feelings, share your insights, communicate with each other. We need to build a community. Community is one of the most important things in the world right now. And don't forget to go to our websites. My website is realestatemindset.org. You can go there to learn how to buy real estate. Everything is free. You can learn how to battle property taxes, or you can go to mockingbirdproperties.com. That is Mitch's website /DCAT. He has an overwhelming amount of evidence. Please join our community. It is absolutely free. I'm going to end this video watching one more video that I hope is going to motivate you. So after you're done listening to this, comment below and let me know whether or not you're motivated.
Go and sit down quietly by yourself for 30 to 60 minutes. 30 to 60 minutes. Most people in our society have never sat quietly for 30 to 60 minutes in their entire lives. Yet I will tell you this method works 100% of the time. That any problem that you have, any difficulty, any challenge, any goal that you want to accomplish, if you'll go into the silence and sit quietly and then listen to the still small voice within. The still small voice within. This is the key.